Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
So as you may know, our country's in a little bit of debt right now. We are $34 trillion in debt in the making of this video here. And obviously, things are going to have to change if we want to cover this debt crisis that we're currently in. And so today I'm going to be bringing you a report from the Congressional Budget Office. And so this is going to detail out that if we want to solve this problem, what has to change? Because we all know what insanity is, and insanity is doing the same thing over and over again, but expecting different results. Well, you can't do the same thing over and over again and expect different results. We're going to get the same results, but probably worse. And that's what we're seeing right now, and that's why the debt is continuing to climb. And so what most experts expect from a big picture is, well, tax rates have to increase, spending has to get reduced, or inflation is going to increase. Those are the basics of what could happen, but what we're going to talk about today in this video is breaking down each of those categories to see what are the more specifics they could do and what kind of impact would that have by making those changes. And so that's what we're in here today on today's video. So as you can see this chart on the screen right now, and if you're listening via podcast here, then I'll be talking through all of these items. But on this chart, you can see that there's all of these lists of things that we could do, and then it shows on the right-hand column the amount of savings that you could have from that. And it's not $501 to $871. It's $501 billion to $871 billion in savings, but they just use that to shorten it up there. And so as you can see on this chart, they got 17 items that they can make changes to put our country in a better position. Now, some of these changes may not put you in a better position moving forward. So that's what we're going to talk through, just some of these ideas of what they could do, just so you're aware and know how to plan, knowing that they can make these changes like the snap of your fingers, right? And as I want to make very clear throughout this report is that the tax code is written in pencil, and they can change it any time. And so if they want to make changes to this, they're going to make changes to this. Although that may put us at a disadvantage, at the end of the day, that's all we know, and that's what's going to be the case. And so what can we do now to put ourselves in the best position? Well, that's through having a plan now, through tax planning strategies, or through retirement planning with a 5-pillar approach is what we say to our clients to ensure that we're not missing anything, to making sure we can get ahead of these things so that if the changes do happen, then we're going to position ourselves in the best way possible. So one thing they could do to make these changes is by increasing the premiums paid for Medicare Part B. And this is something we talk about often, and it's a big risk that I think is actually going to be true because we know it's been true over time. And if you look at Medicare cost over time for Part B premiums, it's been at an over 7% rate per year. That means that every 10 years, the Medicare premiums have doubled is basically the idea. And now I've seen projections for this to be about 6% moving forward, which again, if it's 6% moving forward, that means that Medicare premiums have to double every 12 years. And so as we know with Medicare premiums, there's now an influx into the system of people who need Part B premiums, because at 65 is when you're now eligible for Medicare, and most people are opting into this. And the other concern that we're seeing is that people are living much longer, so more people are being on Medicare for a longer period of time, but also they may be needing more care because they are living longer but not necessarily healthier. And so with those effects, obviously Medicare is going to have to be a higher cost, knowing that there's an influx in the system. When there's high demand, cost has to increase. And so this is one that's very common that we can see, but how will you be impacted? Well, now you're going to have to pay more for Medicare premiums. And as we all know, Medicare premiums are paid out of our Social Security benefit. And so if that's the case, we may not get as much income in retirement from Social Security because we're having to pay more for healthcare costs. And so how can we plan for this? Well, if we can keep our income lower, now we can keep ourselves at the lowest Medicare tier, not cause ourselves to pay increased Medicare premiums over retirement. So as we all know, the more income you have in retirement, the more you have to pay for Medicare premiums. And so if we can reduce our income, and I know what you're thinking, well, Joe, I don't want to eat ramen noodles in retirement. I want to enjoy what I've lived on. Well, you can still do that, but have your money come from tax-free vehicles, which don't count as income, which allows you to show your income lower and allow yourself in the first Medicare tier is ultimately the idea. And so those are planning items that you can start doing today to have more diversification between a Roth and an IRA, to have more tax-free investment vehicles versus everything in tax-deferred or in taxable that have to pay capital gains rates. And so those are all things that you can start planning on and adjusting now. Now, on this list of 17 items, they have 3 that have to do with Social Security, and this is something we, again, say very often, is that Social Security is going to have to change in order to stay in place. I personally do not think Social Security will go away. I think that is political suicide. I think that is something that will not happen, but changes do have to be made, and if they're not made, then Social Security will then not be in place over time, but there's only small changes that they really have to do to keep it in place. For example, if they just reduced everyone's benefit by about 20 to 25%, Social Security would be good to go. Now, no one wants to see that decrease because it is a little bit significant. And so what I expect is a multitude of changes. And that's what this report backs up as well. And so the 3 things on this report is, 1 is reduce Social Security benefits for high income earners. 2 is set Social Security benefits to a flat amount. And 3 is increase the maximum taxable earnings that are subject to Social Security payroll taxes. And these are all valid options to change it. There's also many other changes that they can make. For example, Social Security is 85% taxable now, so up to 85% of that could be counted as income, and it could be lower depending on your income, but for those high income earners, that's the case, is that 85% of it will be counted as income most likely. Well, if you go back to 1980, for example, Social Security used to be tax-free, meaning that you got your $3,000 check without having any taxes come out. Well, that's not the case today, obviously, as I just mentioned, and so something else they could do is a slight change, but now they can make 100% of it taxable for anyone. So right now, if your income is low enough, maybe you don't have to pay any taxes on your Social Security. So it could just say, hey, even if you're low income, still have to pay taxes on it. So those are all changes, again, that are going to bring in more revenue. And so high income earners are always a big target for to get more tax-paying dollars, as you've probably heard and read about. Recently, they said anyone with $400,000 or more in income is going to be heavily targeted. That's been often said. Also, those with a higher net worth are going to be targeted. And you can think of things like the estate tax, which for many right now may not be a big concern. But if you go back many years, it could be as low as $1 million or $600,000, meaning anything over that limit could be around a 40% tax, right? If you have $3 million net worth and estate tax $1 million, well, you have to pay a 40% tax on that $2 million. $800,000 going to Uncle Sam and out of your $3 million. So you're going to see a huge chunk go away to estate tax because, again, they're targeting the higher net worth. And if you have over $2 million, you're about in the top 5% in the population of total net worth. And so they're going to be targeting high income and also high net worth people throughout retirement. And if you've been a diligent saver, many of the people we work with, those Midwestern millionaires, what we call them, they're going to find themselves in those positions because they've been such a diligent saver over all those years. And so high earners are going to be a big target for all this stuff, high net worth for all these items, these 17 items, but again, also for Social Security. And so things they can do is tax those who are working more. And so they could tax the high income earners more, get more revenues from that. Right now there's an income cap which goes up every year due to inflation. They could just continue to rise that over time. And now these higher income people are paying more into Social Security. And then they just could give them less benefits, and so not give them the full amount that they're necessarily paying in for is something that Social Security does well, that Social Security typically rewards people with a lower income, gives them more benefit than someone with higher. Obviously, the higher income earner will get more Social Security, but they won't get more relative to what they've paid in. And so that's another consideration is they can make that be an adjustment as well. And, payroll taxes could also be increased for anyone, not only high income earners, but anyone. And we've seen that over time too. Payroll taxes back when Social Security started in 1935 were not what they are today. Now we're paying 6%, the employer's paying 6%, the employee's paying 6%, and all of that is going into paying for Social Security. They could raise that to 7, 8%, which again is going to bring in more revenues for Social Security to keep it in place longer and also ensure that we can help with people living longer, as we just mentioned with Medicare, and to make sure that we can cover this peak 65 age where 10,000 people are turning 65 every day, which means there's an influx into the system for Social Security, but then also Medicare as just mentioned. So as you continue to read part of this report, some of the other changes, again, are just what I summarized at the beginning. Increase taxes, reduce spending, increase inflation. And so that's what you're going to see for the remaining of the report here is typically what we see. And so, like you'll see here, reduce spending on other mandatory programs. They can reduce the Department of Defense annual budget, reduce non-defense discretionary spending. And so all these items are things that they can do to make sure that there's not as much debt, right? inflows, outflows, we have to make sure that we're not having more go out than what's coming in. And so reducing spending on some type of government programs, we've already talked about Social Security, Medicare, is something else that can be put in place to making sure we're in a better position. Really just making sure we're being better spenders with our money. And I always joke around here, but if we're $34 trillion in debt, do you think we should spend more than what's coming in? You know, if you go to the store and you have $0 in your bank account and you go to the store, what are you walking out with is my question. You're walking out with nothing. But if the government walks in the store, what are they walking out with? Whatever they want, right? And so we just have to make sure we're being more financially responsible as a country is ultimately the idea. And so this report basically says that with all these other ideas they could do and shortcuts they could make in order to get back some of this revenue that we've been spending. And the other one, reduce spending, but also increase tax rates. And that's something that they even say here very bluntly as far as increased individual income tax rates as an opportunity for them to raise some revenues here. And so this is one we talk about very often. I think most people, it comes at no surprise that, again, in order to bring in more revenue, you got to raise taxes. And so that's there. But also another one that, again, may not necessarily mean taxes are going to rise, but they talk about limiting itemized deductions. So many people don't think of that as being what we call a stealth tax, to where it's not changing tax rates, but it's changing something in the tax code to make it less advantageous for us. And we all know that not too many people itemize deductions right now because the standard deduction is so high, but we do know that standard deduction is going to come down in 2026. And so if they got rid of itemizing deductions, well, for those people who have more opportunities, who are more charitable, who have a business, well, maybe they don't have as much opportunity to itemize at this point because they're getting rid of it, and now they're not going to have as much tax savings. And so, again, something else they can do for people to pay more in taxes is not giving you that type of benefit. They also talk about imposing a new payroll tax. And another interesting one they talk about is imposing a tax on consumption. This is one I've actually been interested into. This is something that, you wouldn't have to necessarily worry about paying a tax on your income, but what you spend. So everyone's kind of at an equal playing field, and, could just be more, lead to more revenues over time, and ensuring that there's, less loopholes in the tax code, and just ensuring that's more fair, level playing field for many people. And so with this report, it's really interesting. It's 99 pages long. So if you're a nerd like me and you want to read through all 99 pages, and go for it, or trust your advisor is reading through all this and staying up to date on the things to plan for your situation. So this is something that we really focus on at Peak Retirement Planning, is education and making sure that all of our advisors are up to speed on all the tax rule changes that can happen over time. Again, I say it all the time, tax code's written in pencil, and so we need to be proactive and read and understand what's going to happen. And if you're not doing all of this reading or research yourself, I would highly suggest you get a team who's going to do this for you, because as you all know, we don't know what we don't know. And if you're not going to be diligent enough to do this type of research for your situation, what may you miss is the question I have for you. And so if your advisor's not doing this, as I shared, you may want to look at getting another advisor team to help you ongoing, is something I'd really encourage you about. So if you're looking for ways to help plan for these types of changes that could be approaching, feel free to reach out to our team here. If you're watching this via the YouTube channel, you can go to our description below and schedule a time. If you're watching on our podcast, or listening, I guess, on our podcast, it's hard to watch when you're listening to a podcast. And then you may want to just go to our website there, peakretirementplanning.com. You can apply for a session, and we'll see how we can guide you further. Again, our firm specializes in tax planning. It's one thing that really differentiates us from most other financial planning firms. We still manage our clients' investments. We still help them with estate planning. We still help them with income planning. We still help them with healthcare planning and long-term care planning. But what we do is we center tax planning among all of those things, because we feel that through tax planning, taxes are going to be the biggest expense in your retirement. And so if we can plan for that, and we can get all these other areas of our plan connected to that tax situation, because remember, when we take out money in retirement, it's not just simply how's our investment structured. We also have to look at what's the tax impact of taking out of different vehicles. From an estate planning standpoint, if you want to leave behind money to your spouse or kids, is Uncle Sam going to be a beneficiary on those accounts, or are we going to do that in the most tax efficient way? So as you can see in your retirement plan, everything is based on the taxes. And so, if you're not looking at that in depth, or you're not up to speed on that, as I mentioned, again, maybe a reason to jump on our calendar to see how we can help guide you further, just to ensure you're not overpaying in taxes. That's one of the biggest things people say to us when they come and see us is, I feel like I'm overpaying in taxes. Well, having a solid tax plan, implementing the strategies correctly, can lead to hundreds of thousands of dollars of tax savings over your retirement by just doing the right thing. So with that being said, hopefully you enjoyed the video here today. We'll keep them coming. Just go ahead and like and subscribe, and hopefully you enjoy this content, and we'll see you on the next one.
Since we do not know your specific situation, none of this information can serve as tax, legal, insurance, or financial advice and may be outdated or inaccurate. The information comes from sources believed to be reliable but cannot be guaranteed. This content is prepared for educational purposes only. If you need advice, please contact a qualified CPA, attorney, insurance agent, financial advisor, or the appropriate professional for the subject you would like help with. Peak Retirement Planning, Inc. is an Ohio-based registered investment advisor and able to offer advisory services in Ohio and in other states where registered or exempt from registration.